Before we talk about loan rules, numbers, or documents, I want to start with a situation I see all the time. I recently spoke with a business owner who had been running a profitable company for years. Revenue was strong, expenses were controlled, the business was growing, but every time they applied for a mortgage, they ran into the same wall. Their tax returns didn't reflect what they actually earned because they were doing exactly what smart business owners do. They were reinvesting, writing off expenses, and managing cash flow strategically. On paper, they looked underqualified. In real life, they were thriving. That disconnect between real financial help and traditional mortgage paperwork is exactly why the non-QM profit and loss only loan exists. Instead of focusing on a tax return that may not tell the full story, this loan looks at what truly matters for business owners: actual profitability. Once we shifted the conversation from the tax returns to their profit and loss statement, everything changed suddenly. The numbers were aligned with reality. Hi, I'm Kelly Arriaza, your mortgage and home loan expert with Nexa Mortgage. Today, I want to walk you through what a non-QM profit and loss only loan is, who it is designed for, how it works, and how borrowers qualify using the powerful alternative income option. Now let's go through the understanding the basics of a non-QM profit and loss only loan. To understand why this loan works so well, it helps to start with the foundation. A non-QM profit and loss only loan is a mortgage designed for self-employed borrowers who cannot qualify using traditional documentation. Instead of W-2s or a full tax return, lenders use a professionally prepared profit and loss statement to determine qualifying income. The key difference here is that underwriting focuses on net profit. This means the lender looks at how much your business actually earns after expenses rather than what shows up on your tax return after aggressive deductions, depreciation, or reinvestment strategies. These loans fall under the non-qualified mortgage category, which simply means they do not follow the rigid income documentation rules of conventional or government loans. That does not mean they are risky or loosely underwritten. It means they are flexible in how the income is verified. The goal is to measure income in a way that makes sense for business owners. Who benefits most from a profit and loss only loan? Once you understand how the loan works, the next question is who it actually helps. This loan is ideal for self-employed borrowers, small business owners, freelancers, consultants, and entrepreneurs who earn strong income but minimize their taxable income through legitimate deductions. It is especially useful for borrowers with fluctuating revenue who still show consistent profitability over time. Many of these borrowers are purchasing a primary residence, not just investment properties. This loan is not reserved for investors. It is designed for real people who run a real business and deserve mortgage options that reflect how they earn money. It is also a strong fit for borrowers who have been denied by a traditional lender despite having healthy cash flow and solid credit. When tax returns do not tell the whole story, a profit loss only loan will often fill those gaps. How qualifying income is calculated using the profit and loss statement. Now, let's talk about how lenders actually determine the income with this loan product. Instead of a tax return, lenders review a profit and loss statement covering the past 12 to 24 months. This statement must be prepared and certified by a CPA enrolled agent or a licensed tax preparer. The lender focuses on a net profit, not a gross revenue. The net profit is averaged over a select time period to calculate a monthly qualified income. This approach rewards the borrower who runs profitable business even if they strategically reduce taxable income. To support the profit and loss, lenders also require 2 to 3 months of bank statements. These statements are used to confirm the income shown on the profit and loss aligns with real cash flow. Clean, consistent deposits strengthen the file and make underwriting smoother. The stronger and more consistent the profit trend, the better the loan terms tend to be. Credit scores and down payment expectations. Like all new non-QM loans, credit profile and down payment play an important role. Most profit and loss only loan programs look at a minimum credit score in the range of 620 to 660. Higher credit scores typically result in better interest rates and more favorable terms. Down payments generally start around 20%, although some programs may allow as little as 10% depending on credit, reserves, and overall strength of the file. Investment properties or higher risk profiles may require 25% to 30% down. Loan-to-value ratios are carefully evaluated, especially for a cash-out refinance, where typically maximum ranges from 75 to 80%. Purchase and cash-out refinance options. One of the biggest advantages of a non-QM profit and loss only loan is the flexibility in real-life scenario. Borrowers can use this loan to purchase a primary residence, second home, or investment property. It is also available for a rate and term refinance or a cash-out refinance. For business owners sitting on significant home equity, a cash-out refinance using a profit and loss statement can be a powerful tool. It allows access to equity without needing to qualify through tax returns that may not reflect true income. The flexibility makes the loan useful at many different stages of home ownership and business growth. Now let's talk about eligible property types. Another reason borrowers gravitate towards profit and loss only loans is the wide range of eligible property types. These loans can be used for single-family homes, condos, townhomes, duplex, and in many cases, properties with up to 4 units. Second homes and investment properties are also allowed depending on the program. This gives borrowers more freedom when shopping for a home instead of being limited by strict property guidelines. Why borrowers choose a profit and loss only loan? At this point, many borrowers ask why they would choose this loan over a traditional option. The answer is simple. It aligns more with reality. Profit and loss only loans do not punish smart business decisions. They do not require borrowers to inflate taxable income and change how they run their business just to qualify for a mortgage. Instead, they focus on actual profitability and financial responsibility. For many self-employed borrowers, this loan feels like the first time the mortgage system truly understands how they earn money. Understanding the trade-offs. It is important to be transparent about the downsides. Profit and loss only loans typically carry a slightly higher interest rate than a conventional loan. Down payment requirements are usually higher, and underwriters focus heavily on net profit consistency. There are also costs associated with preparing a certified profit and loss statement if one is not already available. However, many borrowers view this as a worthwhile investment when the alternative is being denied or waiting years to qualify the traditional way. For the right borrower, the benefits often outweigh the trade-offs. How smart borrowers use profit and loss loans strategically? When used strategically, this loan can be part of a long-term financial plan. Some borrowers use a profit and loss only as a bridge. They buy now, continue building income history, and refinance into a conventional loan later when the tax returns align. Others they keep the loan long-term because it fits their income structure better. There is no single right approach. The best strategy depends on your goals, timeline, and business trajectory, built-in structure, and responsibility of the underwriter. One misconception about non-QM loans is that they lack structure. In realty, profit and loss only loans are carefully underwritten. Lenders review credit history, reserves, income patterns, property type, and the overall financial behavior. The flexibility is in the documentation, not in the risk standards. This structure is what makes these loans sustainable and responsible for both the borrowers and the lenders. Here's a bonus tip. Know your numbers before you apply. Before moving forward, it helps to understand your own financial picture. Review your profit and loss statement. Look at the profit trends and make sure your bank deposits support the story and profit loss tells. Organizations and clarity make the process smoother and less stressful. Working with a loan expert who understands self-employment income is just as important as loan itself. Let's bring this all together. When you zoom out, the value of a non-QM profit and loss only loan becomes clear. This is not a shortcut. It is a modern solution for a modern business owner. It recognizes that income does not look the same for everyone and that profitability deserves real consideration. Used correctly, it allows self-employed borrowers to move forward confidently instead of feeling stuck or misunderstood. If you are self-employed, run a business, or feel like your tax returns don't reflect your true earning power, I would love to help you explore whether a non-QM profit loss only loan makes sense for you. You can call or text me at 801-548-0162, or feel free to email me at kariaza@nexamortgage.com, or check out my website at kellyyourmortgageexpert.com and schedule a free consultation. I'm Kelly Arriaza, your mortgage and home loan expert with Nexa Mortgage. Thanks for watching, and remember, your mortgage does not have to feel complicated when you have the right guidance. Let's make the path to home ownership simple and stress-free.